So thanks everybody for being here. This is a really exciting opportunity, especially considering the last 2.5 years, let alone the last 5 months, to hear from and ask questions of a thought leader in our industry and someone who is frankly more well-read, researched, and experienced in these areas than most people you might talk to on a day-to-day basis. So suffice it to say, this is a little bit more than your ordinary water cooler financial chat. I'd gone over sort of the preamble, stay off camera if you don't want to be recorded. And of course, we'll be taking some questions afterwards. With nothing really more to mention and not wanting to take any of Philip's time away, I'm going to introduce him a little bit and then pass it over to him. So Philip Petursson is the Chief Investment Strategist, and in that role, he has a range of investment strategy responsibilities from market and economic analysis to investor education. He analyzes and interprets the economy and markets on behalf of IG Wealth Management clients and works with portfolio management teams to provide clients and investment intermediaries with guidance and commentary on strategies, asset allocation weightings, as well as specific portfolio recommendations. His expertise spans across multiple asset classes and geographic regions. Philip joined IG Wealth Management way back in September of 2021. So he's the new kid on the block here, but that's only after spending over 2 decades in a similar role with Manulife. So Philip is regularly contributing to IG Wealth Management publications. He is frequently quoted in the press and has appeared on BNN, among other notable networks. You would have seen some of his interviews in the invitations I sent out, and is a sought after speaker at industry conferences and for clients of mine. So with that being said, I'm going to pass it over to Philip to start sort of informing us on what's been going on.
Yeah, Kevin, thank you so much for that. I really appreciate that introduction. I'm going to quickly share my screen here. Okay, just give me the thumbs up if you can see that. Perfect. All right. So yes, it's been quite a year to start. And it's funny, as I've been doing a number of these, as you can imagine, I've had some clients say to me that they've never seen the environment this bad before. And I'm actually quite surprised at that, because the environment from an economic perspective is actually quite decent. It's not nearly as bad as some in the media would like us to believe, meaning, I don't believe that we're headed towards a recession, and I'll show evidence of that as we go forward. The equity market, however, and the fixed income market at the same time have been very underwhelming. They have challenged us in terms of our resolve to be investors staying in the markets and so on. A lot of it is centered around the United States, whether it be the S&P 500 benchmark for US stocks that we use, the NASDAQ, which is much more tech-centric. Those are down more than their global peers, in particular Canada, that has fared much better than the United States, Europe even, that has fared better than the United States, despite a war in Eastern Europe, in Ukraine. The European equity markets have actually outperformed the US year to date and since March, where the US has continued to edge lower. Europe actually seems to have found a bottom, as has the Canadian equity market. So what I think is happening, and I'll go into more detail about this, but what I think is happening is the sentiment and momentum in the United States, given that it is 50% of global market cap, is weighing on other markets, yet other markets are significantly cheaper. Canada, for example, is about 20 to 25% cheaper than the United States on a number of different ways that we measure it. Europe is about 30% cheaper, emerging markets 40% cheaper, and so on. So this, again, it's uncomfortable. We don't like looking at our statements and seeing us down on a year-to-date basis, but it's also very normal. And so what I want to do is walk through ways that I think we need to consider the environment, whether it's today's environment or the environment to come, where we might run into a recession at some point down the road, but I don't believe it's in the next 12 months, and how we can maintain our calm in this and not panic and make a mistake with investing that I've seen over and over again, where investors, retail or otherwise, panic given the environment and sell at the bottom, not to return until the market has fully recovered. This is something that I've seen over and over again, and it's crushing because what you see is investors are selling at the bottom, locking in their losses, missing the upside, and only returning once the market has made a full recovery. So I title this How to Survive a Bear Attack. I've used this framework for over 15 years, and there are 4 rules in it. The content is all up to date, but the premise of this has stood the test of time. And the first rule that I want to focus on is rule number 1, vanquish fear and panic. And by the way, these rules have come out of the US Army's guidebook to survival. So if you've read that, then you'll be familiar with them, but most people have not read it. But it's something that I thought was interesting, and there are applicable rules out of this that we can use for investing. The first one is vanquish fear and panic. What I mean by this is there are always reasons to sell, but most of those reasons are the wrong reasons. And yet I've seen this over and over again, and it's almost like clockwork. Following a good year, you tend to see investors flood into the market when the markets are up. And it's almost as if people open up their statements, see the markets are up 20% or whatever it might be, and you see cash coming in. That's not quite always buying at the top, but it is buying after you've seen very strong returns. And then we get the opposite. When we see on a rolling 12-month basis the US stock market down, and I follow the US investors as well, you tend to see the selling happen. The majority of the selling comes at the bottom of the market. And that's exactly what we've seen this go round too. We saw $53 billion come out of US mutual funds, equity funds, and balanced funds, including ETFs, in the month of April. Now, I don't know if April we know isn't the bottom. I don't know if May is going to be the bottom, but this does feel more like a correction as opposed to a recessionary bear market where the market will continue on and the average drop tends to be about 35%. That doesn't feel like where we are today. Now, when I talk about vanquish fear and panic, I usually refer to these 2 slides. The first one being the chart of the S&P 500. This is the benchmark for US stocks going back to 1927 to where we are today, roughly. And I've overlaid on top of it various geopolitical events. Often with these geopolitical events, I'm asked, what does it mean for my portfolio? For example, 2017, if you recall, Trump was throwing barbs over at North Korea, and there were headlines of North Korea testing ballistic missiles and so on. And immediately the question is, well, what if we get a war between the US and North Korea? What does it mean for my portfolio? Now, this was the 3rd time that we've gone through a North Korean nuclear crisis. And largely, it's just a headline grabber and not something more material. And that's what this proved to be. We also had the 2020 global pandemic. Obviously, that was a more meaningful event, but as you can see on this long-term chart, it was very short-lived. Not necessarily the pandemic, but the market response to it. Then you can go back to 2011 Arab Spring and so on and so on. It's not the geopolitical risks that result in sustained market volatility or some type of destruction of capital. It's the economic risks. So here's the exact same chart again, but overlaid with recessions going back to the 1920s. Now here you can see that bear markets or significant drops in the equity market in the United States coincide with recessions. There have been 4 instances where we've had a bear market outside of a recession. 1946, where the NYSE raised margin requirements that triggered a bit of a sell-off or margin call. You had the 1962 Kennedy slide, 1966 flash crash, and the 1987 Black Monday. None of these were associated with geopolitical risks nor economic risks. They were just, we would call them very deep corrections or shallow bear markets triggered by maybe some other type of volatility in the marketplace that really couldn't be pinpointed. But in every other example, the bear markets came with recessions. Currently, the S&P 500 is down 18.6% from its January 3rd high to its low of last week. It remains to be seen if we go lower. But for the time being, what I need to do is now assess whether or not we're headed towards a recession. So it's okay to be fearful. There's a lot going on in the environment. We have higher inflation. We have central banks raising rates. We have a war in the Ukraine. We have the equity market volatility. But what we shouldn't do is allow that fear to become panic, because that's when we make mistakes. And in fact, I'll lay out the scenario in a couple of slides why I think the coming year is going to be much better for investors than what I thought at the beginning of 2022. So that takes us to the second rule, which is know your environment. Okay, so I've been saying a couple times now that we do not see a recession. Well, there are a couple things that we have to address for the first half of 2022. And there are 5 key themes that I think are weighing on the minds of investors. First one being higher inflation. In Canada, we're seeing inflation at 6.8% on a year-over-year basis. This is the highest level that we've seen since the early 1980s. It's modestly higher in April than what we saw in March. March was 6.7. So what it tells me is that the rate of change for inflation is slowing down quite significantly, such that we might be near the peak of inflation, and therefore we might see inflation start to moderate. In fact, that's what my models are suggesting through the remainder of this year. But nonetheless, we're seeing inflation that a generation hasn't seen. There are colleagues that I have worked with in the past that have never seen inflation over 2% in their lifetimes. And now they're seeing it, and perhaps they don't know quite how to react. And so they're perhaps overreacting to it and calling for a recession, which again, isn't in the cards in my view, based on the data that's in front of me. However, higher inflation is leading to higher interest rates. Bank of Canada has raised rates to 1%. In the next week or two, they're going to raise rates to 1.5%, and we're going to go on from there. In the meantime, we've seen bond yields move higher in anticipation of the Bank of Canada raising rates, similarly in the United States. Those two things, though, do weigh on the minds of investors, and in the past have triggered corrections. Now, in hindsight, it's very easy to see the cause of the correction that we've had over the last 5 months. It's overvalued equity markets, predominantly in the United States, coinciding with higher inflation and higher interest rates. But again, I say that with hindsight. At the time, we did recognize that equity markets were overvalued at the beginning of the year. Immediately, you might ask, well, why didn't we do anything about it? Well, markets are overvalued 50% of the time. Right? The markets are never exactly fairly valued. There's some function above or below. And you could see that the markets were overvalued, but to suggest that, oh, well, we should be trimming our equities or selling equities in this can lead to mistakes. Valuation is a very poor predictor of short-term performance. You can be overvalued for an extended period of time, if not years. And just because you're overvalued doesn't mean you can't make money. In fact, if you look at it by one of the ways that I measure it, preceding the 2001 tech wreck, you could see that the markets were overvalued as early as 1987. But from that point in 1987 to the bottom of the market in 2002, the markets were still up. So it's difficult to make a call on just the markets being overvalued. Typically, you're better off just riding through it. What you want to do, though, is avoid recessions, because that's when you tend to see very deep bear markets, where, for example, the last two, excluding 2020, we saw drops of over 50% for the S&P 500. That's what we can avoid, and that's more predictable as opposed to just some valuation metric. Nonetheless, we have the equity market correction. In the US, equity markets are down off the top about 18%. In Canada, it's about 5%. In Europe, it's about 14%, and so on. And the NASDAQ, being the worst of it all, down about 30% off of its November high. Compounding all of these fears, though, is the Russia-Ukraine war. Now, again, geopolitical risk doesn't tend to have a lasting or material impact on the markets, with the exception here of energy prices. Russia being the third largest exporter in the world of oil, obviously, if they engage in a military conflict, you're going to see sanctions, as we've been seeing, and that's going to drive up the price of commodities, in particular oil, by, my guess is $10 to $20 a barrel. Nonetheless, oil prices were moving up before the war and likely will continue to move up after the war because of very, very tight supply. So the ironic beneficiary to all of this is actually the TSX. So where the S&P 500 was down today, the TSX was actually up. So Canadian investors have actually benefited from what has been going on in other areas around the world. I mentioned interest rates. Bank of Canada is raising interest rates. We're seeing this in mortgage rates. We're seeing this in other lending rates, and it's going to continue over the course of this year. Bank of Canada is likely to get to 2.5% for its overnight rate, but mortgage rates are near their peak. I think we can see a peak probably at around 5%, or sorry, 6% for mortgage rates. And that's because the bond markets have already priced in very aggressive rate hikes by the Bank of Canada and by the Federal Reserve. So I don't necessarily believe that the Bank of Canada will get to 3% or 2.75%. I think they're going to be limited to somewhere between 2.25% and 2.5% for its rate increases, because they're going to start to see inflation moderating. And that's the sign that they want. They want to see inflation start to come down slowly. We're not going to get back to 2% in short order, but we're going to get there over the next couple of years. And as long as we're headed in that direction, that allows the Bank of Canada to be less aggressive with rate hikes. Now, coming back to the question of recessions, because this one, to me, is grabbing a lot of headlines by economists out there that I would characterize what they're offering as catchphrase economics. I don't necessarily think that there's a lot of data to support the fact that we're headed towards a recession in the United States. We just don't see that at all. And here's one thing that I point to that is a good snapshot of the health of the global economy. I look at the 5 largest exporters around the world: China, the United States, Japan, Germany, and South Korea. And I map or plot their year-over-year change in export growth. What this means is if you're shipping more things around the world, then people are consuming more things, and this indicates a healthy economy. When year-over-year export growth is falling, as it did in 2015 or as it did in 2019, it indicates a weaker global economic environment. In fact, in 2015, we were very close to a recession. We had an earnings recession. Profits were down for more than 2 quarters. We had a manufacturing recession where manufacturing was down for more than 2 quarters, but we didn't have a broad-based economic recession. Nonetheless, markets were flat in 2015. 2019, similarly, we were seeing negative export growth on a year-over-year basis. We believe we were headed towards a recession over the course of 2021 or 2020 and 2021. Not knowing COVID actually accelerated that. But where we are today, you can see on the far right, global exports are still quite healthy, still quite positive. We're still moving things around the world. People are still buying goods. And so it's very difficult to suggest that we're headed towards any kind of recession when you have global trade looking as it is. And this is similar for housing starts in the United States, similar for availability of loans and so on. So I like to put aside the headlines, the negative headlines of the top left here, with Wall Street predicting a 2023 recession. Again, I don't see that over the course of the next 12 months. Beyond that, hard to say. Perhaps we could see a recession in 2 to 3 years, but I wouldn't be doing anything in my portfolio about it today. What I prefer to focus on is the hard data, top right or bottom left, top right showing that those on unemployment benefits in the United States are at the lowest level that we've seen since the late 1960s. And there are still 11.5 million unfilled jobs in the United States. So with unemployment at 3.6%, I think it can continue to go lower over the course of 2020. So, the sign on the bottom right, beware the bear. I've never met a wealthy pessimist in my career. So that takes us to rule number 3 then. If the environment is actually good, what should we do about it? Well, let's use history as our guide to take advantage of where we are and what it might mean over the coming year. So when you go back to 1945 and we look at the corrections, there have been 22 corrections. So a correction is a drop in the market, the S&P 500, by more than 10%, but less than 20. There have been 22 occurrences of that since 1945, and there have been 11 bear markets. So in total, 33 corrections are bear markets. Now remember, only 4 out of the 11 bear markets occurred outside of a recession. The others were all associated with recessions. The average drop in a correction is 14.3%. And it lasts about 93 trading days or 4.5 months. Now, the recovery from there is 90 days, or again, 4.5 months. This correction has been just over 18% for the S&P 500, so a little bit below average, I guess, if you put it that way, by the negatives. But what I'm encouraged about, again, not knowing whether we formed a bottom or not, but I think there are signs out there that suggest we're close to it if we haven't already seen it. What I'm encouraged at is 90% of the time, 1 year following the bottom of a correction, the S&P 500 is up 25% on average. When the VIX breaks above 30, the VIX is the volatility index. It's known as the fear index. It's a good gauge to market capitulation, or when perhaps we've hit a bottom in the market. When that breaks above 30, again, 90% of the time, the markets are positive 1 year forward, going back to data that we have since 1990, with an average return of about 23%. And there's other indicators that would suggest that, you know, if we're not at a bottom, we're forming a bottom. And so the market opportunity over the coming year is actually much improved from where we were in January, where my expectation was over the course of the next 12 months, we could see a return for the S&P 500 that would be below average, in the range of the low to mid single digits. This correction has been deeper than what we thought, but again, a correction nonetheless. It's very reminiscent of what we saw in the fourth quarter of 2018, where the S&P 500 fell 19.9% over the course of September to Christmas Eve, before recovering into 2019. That is a period, or that was a period, where we had interest rates moving higher. Not quite, well, actually similar to where we are today. The 10-year yield back then was 3.25%. Didn't quite hit that level today. And the Federal Reserve was raising rates. So this environment is very similar to that environment, or very similar to what we saw in 2011. Again, when the market fell 19.9%, as the Fed now was unwinding its quantitative easing program, and talking about potentially raising rates. So provided this doesn't turn into a recession, which if this did, it would look unlike any recession that we've seen in the last 50 years. This continues to be, in my mind, a typical correction in the market that is leaving us with much better valuation and much better prospects going forward. And lastly, I just want to say, you tend not to see a recession when earnings are rising. Corporate profitability this quarter is up 10% on a quarter-over-quarter basis, or sorry, year-over-year basis this quarter, and the full four-quarter earnings growth rate is 40% over the 4 quarters prior. So if we started to see profits fall, or unemployment increase, or housing starts to slow down, that would be a sign that we should be more concerned, but we have none of that. So this does feel like just another typical correction. Lastly, I want to show this chart because I think it's very telling of where we've come over the last 5 years. Now imagine 5 years ago, if I had said to you, over the course of 2017 through 2022, we're going to see trade wars between the United States and China, the United States and Europe, the United States and Canada. We will see a very, actually, those trade wars will result in a correction of 19.9%. After that, we are going to have a very contentious election. In fact, one of the candidates will actually claim that the election was fraud. That will result in a riot on Capitol Hill. And through all this, we're going to be dealing with this global pandemic called COVID, which was going to shut the global economy down for weeks at a time. That will result in a bear market of 34%. But over the course of the 5 years, when we get to the other side in 2022, your average return will be, now this is through April, 12%. May through where we are today, over the last 5 years, it's a little bit below that, at about 10 to 11% annualized, or a 70% total return over that time period. That's very hard to imagine, but that's where we are. We've come through all of this risk, turmoil, volatility, political and otherwise, and we still see gains in the marketplace. If we look forward over the next 5 years, I think it will continue to be a very bumpy ride, but I think it will continue to be profitable for us as well. Lastly, I'll just leave it here. Rule number 4, do not be afraid of strange noises in the night. Now, this is very important. If something intends us harm, it will stalk us silently. And what I mean by this is we cannot predict risk. That is not our job. That is not what we're good at. What we can do is manage risk. We manage risk to the data available to us. But more importantly, the work that Kevin does in terms of the financial plan that we work with our clients on, it incorporates things like corrections, recessions, bear markets in the plan. We don't believe that the markets are going to grow 10% consistently every single year in a nice smooth line. It is a bumpy ride, as we've seen going back to 1927, and it will continue to be a bumpy ride. But if we do our job, manage risk, manage the plan, invest in good quality businesses that generate profits and share those profits in terms of dividends, and invest in fixed income vehicles that pay coupons, then we're going to continue to move along the path to our financial goals. We're going to come across these bumps along the way, but that's just par for the course. So let me close it off, Kevin, and then we can open it up for questions. Basically, I want to reiterate, there's a lot of volatility. This volatility, while uncomfortable, is completely normal. We've been here before. The global economic environment is better than people believe. Might not be as good as we hope, but it certainly is better than people believe. There isn't enough evidence in my mind to believe that we're headed towards a recession. This doesn't look anything like recessions in the past, and recessions do have common characteristics, and really none of them exist today. So we can get through this volatility, through the other side, take advantage of the volatility. In fact, we can put ourselves in a better position for the coming year to coming years. So why don't I pause there, and I'd be happy to take any questions.
Awesome. Thank you so much, Philip, for sharing that, putting that together. A few of the questions I had already were answered in there with regards to the differences between standard market corrections and impending recessions and some of the indicators that you look for. But something that I'd like to sort of ask about right now to get the ball rolling is the current climate has been beneficial to the Canadian economy. For commodity prices and other resources. Following whenever the end of the conflict in Russia-Ukraine occurs, do you see that sort of outlasting here in Canada? And I guess a two-parter is considering the sanctions against Russia and the flow of natural gas and oil through Ukraine. Is the world going to more quickly, or Europe especially, going to more quickly move away from its reliance on oil and gas as a result of what's happening right now? Or might it kind of revert back to the mean as soon as there's no more conflict?
Great question. So let me start first. I do want to, I think a good way of describing, I'm going to go back to it in terms of, is this a correction or is this something more? Thinking about it this way, Kevin, because I think it's worthwhile just revisiting that really quickly. The environment that we're in, is it disruptive or is it destructive? And so there's a real distinguishing difference between those two. A disruptive event was COVID. COVID was a pause on the global economy, right? It disrupted our day-to-day lives, but did it result in a destruction of capital? Well, no, because governments helped businesses along. Versus 2008, where here we did see a clear destruction of capital. People were losing homes, losing down payments because they couldn't afford the property, right? They were losing the equity, and the banks, because of the bad loans they were making, were failing, and we saw capital being destroyed. That's how we need to think about this. In this environment, is there any destruction of capital? No. Banks are very, very healthy, and people are making money, jobs are plentiful, and so on. So any slowdown as a result of the rise in interest rates is more disruptive than anything else. Okay, so that's the first question there. In terms of oil, we have seen oil prices move up. Now, interestingly, oil prices were moving up before the war. I was in Calgary last week, and I haven't seen people so happy since 2013. The oil prices were already above 2019 levels by the middle of 2021. So we hadn't even heard anything about Russia building up its troops along the Ukrainian border at that time. So what that tells me is there was other factors that were driving the price of oil higher, and that was very, very tight supply. over the last 5 years, there's been a lack of investment in new oil development because of ESG factors, pressure on oil companies, and so on. And so where we ended up today is actually almost a shortage of oil. It's very difficult for the world to keep up with the demand when the global economy is kind of moving ahead at normal speed with normal demand for oil, and we haven't made the investments required to keep up with it. So that's why oil prices were heading up. That's why oil prices are where they are. Russia has contributed $10 to $20 a barrel to that price of oil. So today I think it's around $110 a barrel. If the war ended tomorrow, maybe we'd be back down to 90, maybe a little bit lower than that. But I believe that we would be headed higher over the remainder of this year into 2023, again, because of that tight supply. So I think this oil environment that as Canadians we find ourselves in today is the start of another commodity super cycle. The last one was 2000 through 2010, roughly. I think we're starting the next one. To your question of can Europe or the rest of the world pivot away from oil faster? The easy answer is no, because we just aren't producing enough electric vehicles to allow for that. Now, oil demand for gasoline is about 40 to 50% of a barrel of oil. The rest is jet fuel. We don't have EV planes yet. It goes into other chemicals, cosmetics, clothing, plastics, and so on. So you can see the amount that utilized in gasoline perhaps diminishing, but that's a 40 to 50 year timeline. What Europe is going to have to do is become less reliant on Russian natural gas and Russian oil if they want to have any sanctions influence over Russia and keep the bad actors at bay. They can't pivot as quickly to renewables as we would like. So it's going to take some time before we get there. What they're going to do is pivot to new supply, whether that's Middle East, whether that's maybe Africa, maybe the North Sea, who knows? But I do think the future is going to be less reliance on Russia for their energy needs.
Right, thank you. All good answers. There's a few more questions I'd like to ask, but I think that sort of leads into the variable territory is, what does that mean for other global superpowers if all of a sudden Europe's reliance changes from Russia to them, and how does that change the climate? But again, I don't know if there's an answer to that isn't a guess or a stab in the dark at this point.
No, I would just say, I think if anything, we might have some interesting talks about Keystone again. It might come up over the course of the next election or two, because that's something that, talking about North America and North American energy reliance, it's something that would benefit all of North America if we did have more pipelines.
Interesting. And interesting how quickly a tune might be able to change given the environment. No pun intended, I guess. Okay, well, I've got a couple more questions and I'll ask them. And if anybody else in the room wants to ask some, by all means, please add them in the chat box or let me know if you want to talk. But I want to sort of bounce back to interest rates. And so Canada as an overall economy has far fewer market sectors than, let's say, our neighbor, the United States. And the real estate market is a big one. And I know living here in BC, I live here in Toronto, so there are some major provinces and cities where people are leveraged pretty high to get into those properties. And so interest rates rising like they are puts into question their solvency or their ability to maybe maintain those payments. I know I've had questions or conversations with clients where they're sort of running the numbers. So if interest rates rise by 2.5%, I don't know if I can keep in this home. How does and you talked again about Bank of Canada kind of limiting the ceiling of where they're going to slowing inflation down, but how do they navigate that decrease in inflation in conjunction with also acknowledging that we've kind of let real estate bubble kind of continue to rise, and now there's almost a moral obligation for the government to make sure that people don't end up homeless at this point, because I think maybe a market crash in the real estate sector is something that could cause a Canadian recession.
Yes, you're right. I think the risk of recession in Canada is much higher than that of the United States because housing is such a significant part of our GDP or our economy. It's a disproportionate amount to our economy, and it's something that should perhaps have been dealt with a long time ago. But that's for others to debate, not me. I do think that the rising interest rate environment, well, it is starting to have an impact. We're seeing it in terms of prices. We're seeing it in terms of sales. It will continue to have an impact. As the Bank of Canada raises rates. I think we're near, again, the peak for mortgage rates, though. I think I saw they were about 5.5%. They can go a little bit higher from here, but the market has already priced in the bulk of rates that the Bank of Canada is going to exercise over the course of the next year. So I don't think we can see much higher mortgage rates. However, truth be told, anyone renewing a mortgage today, a 5-year mortgage today, is going to pay more than the expiring mortgage. That's just the way the numbers work out, and it could trigger a recession. The Bank of Canada's attitude, I think, right now, continues to be solve today's problem, worry about tomorrow's problem tomorrow. Today's problem is inflation. Solve for today's problem. If it triggers another problem, right? It's like you go in your doctor's office and there's a sign, only one ailment at a time, please. And that's kind of, I think, what the Bank of Canada is working on. It's like, we'll deal with inflation now. If we start to see a downturn in the Canadian economy, well, we'll pivot and deal with that. But at that point, some of the damage has been done. From my perspective, though, Kevin, I have to look at it in terms of what does that mean for the markets? Well, for the Canadian stock market, it doesn't mean anything at all. Unlike the US stock market, we don't have publicly listed home builders. Most of our home builders, if not all of them, are private. And so it doesn't really have any impact to our stock market performance, and our banks actually, are going to be fine too, because people will continue to pay the mortgage, but they'll just spend less elsewhere, right? The first thing people are going to do is stay in their homes. And it does mean that we could see a recession in Canada. Bank of Canada will deal with that problem later. I don't think they're too concerned about it right now. Their main focus is reining in inflation, which was a problem that they created through COVID.
Absolutely. And I mean, obviously it's a problem that's created all around the world. And I think, again, speaking to people not being able to afford their mortgage if interest rates rise, those often are the same people who are now balking at gasoline prices and grocery prices. So I mean, it's which straw breaks the camel's back, I guess, and hopefully we can kind of slow inflation without interest rates going too high, and people can kind of find themselves with a lesson learned, no more harm done, versus being an unfortunate statistic.
Yeah, this is, I do want to add, though, this is more of a Canadian phenomenon. If you look in the United States, US housing affordability is 133%. So what that means is the average American has 133% of the income required to carry the average house at current prevailing mortgage rates. The American indebtedness is far below Canadian indebtedness. So as mortgage rates are going up in the US as well, and we're starting to see some housing sales slow down, housing is not as meaningful to the US economy as it is in Canada, but housing starts continue to accelerate, and Americans can afford their homes. The average house in the US is like mid 400s versus Canada, that's twice that.
Absolutely. Not a question, but Bill in the room here is a doctor. Says he retired, but I think works more now that he's retired than he did when he wasn't. But the sign in doctor's offices: come in with 4 problems, leave with 3, instead of pick your problem and only one. Yeah. I'm gonna bounce around here again. Sorry to steal all the air in the room, but I've got lots of good questions for you. So one of IG's flagship investment products is iProfile. We've got a team of people who build kind of the infrastructure, and then we go out and find the best money managers in the world to manage that. And one thing I noticed and learned about this year is the Canadian pool, the Canadian equity pool within that that program. Was doing very poorly this year relative to its peer group and relative to the index. And I learned that that's as a result of divesting, I believe, from oil and gas in previous years, which up to and very specifically including the pandemic, I think very much worked to our advantage. This year flipped on its head a little bit and not so much so. But what does that necessarily mean as an investment philosophy going forward? Does our investment department, do you look at the climate we're in right now with commodities and say, okay, maybe it's time to buy back into commodities, or into sort of Canadian oil and gas, pardon me, or change that investment philosophy? Or you're sort of steadfast and we made the right decision. 1 year is not enough data to change that philosophy, and we'll continue moving forward.
No, the philosophy, or what has been done since then, and let me go back and explain it. The underlying portfolio manager had the view, they are a value manager. So what we've done within the iProfile portfolios is divide up responsibilities across a number of different managers. Some managers we choose to be manage the growth portion of the portfolio. Other managers we choose to be value. So we get a good blend of both, and we hope the active management allows for outperformance of each category that we have within the mandate. The value manager, the value benchmark actually had a decent weight to energy, but the value manager, for whatever reason, their philosophy led them away from that. And so the underweight to energy is what led to the underperformance in the portfolio, as energy has been the top performing sector in Canada this year. As you pointed out, Kevin, in prior years, the underweight to energy served them very, very well, because energy was a laggard on the TSX for a number of years, really since 2014. But our view is that we don't want one manager to be so far away from their benchmark. What we really want them to do is to pick the best companies within their mandate, and not make huge sector bets like that. That's more of almost like a rotational bet, saying, well, I don't want to own energy, I'm going to own energy. So what we've done since then is actually replace that manager with a value manager that is a little bit closer, has an exceptional track record, owns energy, sees the value in energy. So what we want to do, we don't want to restrict managers. We don't want to tell managers, no, you have to own this, you can't own this, but we do want them to be closer to the sector weights, but find the best opportunities within each of the sectors, while giving them parameters to be overweight or underweight sectors, but not to be completely underweight sectors that they have no exposure at all. There's actually risk. There's great risk in that as well, is not owning anything, just as much as there is owning too much of something. And so that's what we try to do on an ongoing basis, is to identify managers that do a good job, outperform, and when managers, for whatever reason, change their philosophy, change their style, deviate from their process, replace them with managers that are better suited for what we're trying to achieve.
Awesome. We got a question in here from Bill, and he asks, will the change in business models in the wake of the pandemic, examples are online purchasing, working remotely, change commercial real estate, will they change the investment scene significantly? And I guess what you look for in building portfolios.
Well, the greatest change that we've seen is actually with office space, not necessarily with malls. Yes, e-commerce has picked up, but if you look at mall traffic is up quite significantly. People want to get out and they want to walk around the mall, even if they're not going to do too much shopping. Yes, they're buying online, and that continues to grow. But that doesn't mean that the malls are empty. I mean, go to your local mall and just on a Saturday and you'll see how busy it is. It's a social thing, shopping. It's not just a needs thing. However, with the office space, this is something that is very interesting to see. So now office real estate has taken a significant hit, obviously because people haven't been in the office for the better part of 2 years. We are slowly starting to return to offices in North America now, in the US a little bit more so than in Canada. And it remains to be seen where we end up. How much of the new office regime will be part-time, some hybrid version of in the office a couple of days, out of the office. Some departments perhaps will be all out of the office. Some will be in the office. To be honest, I don't know. I don't know what it looks like. I do know. I feel confident in saying it won't be 100% occupied as it was pre-COVID. The trend pre-COVID was starting to be a little bit more hybrid. I think COVID accelerated that. I think COVID proved that we can be just as productive, if not more productive at home as what we're doing right now. And so I think it does call into question what to do with all the office space and how or how often we need to be in a physical office to do our job. So yes, it will definitely change the dynamic going forward. What that change means, I don't think anyone knows yet.
All right. I don't have any more questions that you haven't answered or didn't go answered in your presentation. I'll leave a couple more seconds here in case anybody wants to type a question in the chat box. And if that doesn't come in shortly, then thank you very much, Philip, for taking the time this afternoon to talk to us about this, to answer those questions, and for letting me record this so I can share it with those who weren't able to make it today.
Kevin, it's been my great pleasure. I look forward to doing this again.
Okay, take care and have a good evening.
You too. Bye-bye.